Welcome to the National Bank Energy Conference session with National Energy Services Reunited, NESR. Today joining us from the company is Chairman and CEO Sherif Foda to discuss what I would say is probably one of the most unique publicly listed companies that we have in our coverage universe, if not currently listed today in North America, with exposure to oil and gas operations throughout the MENA region. So lots to talk about here. And with that, Sherif, I'll just ask you, with your unique exposure to the OPEC group, what are you seeing from them in the tone in their commentary, and how do you see their strategy for production management to play out here in the medium term?
I believe that the OPEC plus strategy has been very clear from the start. Since they met last time, and then their following meeting, I would say last week, is to make sure that they are the most reliable supplier to the world, and they have that buffer that they can manage in case there is a need in the world or the demand comes back. They were able to put back the production at a very fast pace. So you saw back in April when Saudi managed to produce 12.4 million barrels per day, which basically was phenomenal. And everybody was like, some people who had the question or skeptical, can they produce that amount do they have this buffer, and can they produce this amount of oil, which they did. And I think if you look at the strategy, is they want to ensure that they maintain that reliable supplier. Meanwhile, they do not want to flood the market and destroy the price if there is no need. And meanwhile, I think it's very adamant between, I would say, the Russian especially and the Middle East folks, is they want to ensure as well that there is no uptick in oil price that becomes again the same problem of the past, where basically you could say that the shale comes back very quickly, and then they have this balance again between them, right? So I think it's all about balancing the market, making sure that they have that buffer to ensure that they can provide the supply. And if I look at worldwide what's happening, definitely that buffer exists in the Middle East. And if the demand goes back to 95, 96 million barrel, they will be able to supply. They have what it takes, and they can switch it on pretty fast, especially, I would say, the Saudis and the Emiratis.
And so as demand comes back, that will dictate them to bring on their supply. Do you think there's a price level that they have in mind as far as what they want to maintain or manage towards? Do you see any indications from them that there's a price level that they'd be comfortable with?
I think they are very comfortable with the current price, what it is. I believe if the price obviously it moves a bit more up, it helps their economy in most of the countries. But definitely they do not want to see, in my opinion, the price crashing as it did in this year. I don't think that they want to see again the $25, $30 oil. So and it was obvious with the last meeting, and they believe that despite the fact that they had an agreement to put back 2 million barrels by January 1st, they agreed that they do this gradually, and the agreement is basically dictate or indicate they're gonna put back 500,000 every month. Whether they even do that or they put the 500,000 and then revise it again end of January, which is the case today, right? They're gonna meet and decide what happens based on the pandemic and based on the resumption of flights and the demand getting back to this 95, 96 million barrel a day.
Yeah, exactly. Well, we don't want to see the prices crash either, so we're in alignment. Just with respect to the fact that there's 7.2 million barrels a day off the market today, I view that as a pretty significant backlog of opportunity for NESR. We saw a big uptick in business for you in April when they did ramp production up to 12.4 million barrels a day. So do you expect that as that production comes back on stream, you will be a benefactor of incremental business and revenue?
Yeah, absolutely. I mean, our philosophy has always been that we are very focused in the region. We will not go outside the region. We will not operate in North America, for example, and we see this as they ramp up the production and get back some of the rigs that they shut down, definitely we will be the beneficiary here. But something that is very important, people have to understand as well, they do not cut the activity as they cut the production. So there is a total de-link between production and activity. There is obviously a proportion there, but it is not the same like what you think about it in North America. In North America, when the price or they shut down the production, they will immediately cut down the rigs and immediately lay off the frac fleets. In the Middle East, is very different because this is usually a national oil company that have a lot of social program according to the employment, the long-term contracts, etc. So they do not shut down as much. So you won't see as well a ramp up like very significant. It's a gradual ramp up because the shutdown was not that significant. The majority of the cut that they do is on their budget is the project, what they call nice to have, or something that is a frontier type, like they go offshore where they never did offshore in some of the countries, or they drill, or they put some monster midstream or downstream project. This they push to manage the budget, but the activity, obviously it went down, but it's not as down as you saw in North America. And that was, by the way, this is the same what happened in previous cycles. And you never had the minus 70% or minus 80%, which is what you see in North America. Rig count goes from 1,000 rig to 200. This never happened in the Middle East.
Yeah, and I think that's an excellent point to make to certainly the Canadian investor base who views energy services as more of a cyclical investment. That's not the case here. I mean, it's a much more structural business line in the Middle East, and I think that's a huge attribute for NESR. I'd also wonder, I mean, as the fields in the Middle East mature, are you finding that they're higher maintenance and there's more work to be done in association with them that NESR is also a benefactor of?
Yeah, absolutely. I mean, if you look at the intensity of work, as we always said it before, it's all these fields in the Middle East is going to go to higher intensity when you have less green, more brown fields, and it depends which country you're in. And so the Middle East obviously is very big. So you have already countries there where they have a lot of brown fields, like for example, Egypt, and you have one that is more balanced. Regardless of both, you do not have anymore this $1 a barrel production everywhere, right? Which is what used to characterize Gawar, Burgan field, Zakum field. This is where the monster fields and each well is like, 15, 20,000 barrels. They still have those, but they have a lot as well of where you need to do maintenance, you need to do cold jibbing, you need to change artificial lift, you need to frack. If you look at the whole gas opportunity in the region, it's unconventional, which is very similar to North America. If you look at the Permian or the Eagle Ford, and the analogy to it to Jafurah Basin, for example, in Saudi Arabia is very similar. And now you drill pad wells, you frack 40, 50, 60 stages per well. And that's why now they are getting the efficiency, which means that high intensity of work to get the same production. And very good analogy, you can look at the rig count 20 years ago and the rig count now. It's not the same as the US, but still the intensity of work is multiplied by a factor of 4 or 5 what it used to be just 20 years ago, right? So
yeah, it's such a robust base of activity for you that it's a pretty compelling opportunity. Now, NESR has been a high growth entity since inception, and you have some pretty high aspirational growth targets. Can you talk to us a little bit about where you see the revenue base of NESR growing to over the next few years?
Yeah, so when we put the company together and when we said we're going to be the only national company today that are in the Middle East that is publicly listed, we are the only actually entity in any industry that is publicly listed in New York. But we looked already that we want to quadruple the company size in 5 years. So the company was around $500 million when we put it together. And we said we want to be $2 billion by 2022. And if I look at the market size of the region is 20 billion. So $20 billion, the market size, we want to capture 10% of it. And today we are more or less 4%. So very clear growth target. And we can do that. Why you can do that? Because most of those countries with the national oil company have an objective to have an ICV or a local content, local companies or national company, making sure that they can capture 50, 60% of their work. So we are actually, when we get more work, we help them to achieve those targets. So I see a lot of opportunities in the same countries where we are in. We are, I would say, strong position like Saudi Arabia and Oman, and a lot of the where we are very small in other countries where we will able to put the segments that today we have 20 segments, 20 product line. How can we put those product line into the countries where we are very small? So Kuwait, we are small and we are gaining contracts, and now we want to deploy. UAE, we have only 2-3 segments. We want to deploy 5 or 6 segments. Iraq, we just entered Egypt with the acquisition of Sapesco, and we want to have industrial services that Sapesco has, and the company today, NESR, does not have in the rest of GCC. So we are taking that portfolio of segments and trying to bid and tender into work for the GCC. And there will be a lot of this work, because today, if you are doing all these projects with the downstream pipeline, you're getting new gas in the stream, you have a lot of industrial service that you have to do, which is segment we were not in before. So we are penetrating that portfolio. So overall, I would say the growth profile is across the region, and we have some pockets as well with new countries, like we did with Chad. We're looking at Sudan. We're looking at other couple of countries where we can enter. Today we are not existing. So entering those countries, some of it even in East Africa. So if we start there, then you will be able to make the growth. And definitely M&A, right? So the M&A portfolio is something always we said we are going to do organic and inorganic to do the quadruple. And the inorganic you have now as we grow, as the I would say the energy sector in the Middle East saw that this new theory of being a public, not only private, is not a bad idea, to be a shareholder and become part of that group. And that's where we are trying to attract a couple of companies to come and join the group, and that obviously enable us to streamline and enhance our growth much faster than what we can do organically.
And just moving back to the market share comment, I mean, you reference going from 4% to 10%. Is that predominantly just taking work from the big three? And what drives that? Is that just that local advantage that you have, or do you also have higher, quality and deliverability of services as well?
Yeah, so I tell you, it's a mix. So what we always said since the beginning of the company, that we want to have a very clear path to the service delivery and becoming customer centric. So we want to be like the darling of the oil company. So they know that they can rely on us, and when we say something, we do it. It's not like we are selling something. So if we cannot deliver on some of the segments, we tell the customer, no, we cannot deliver on that, or we do not want to be in that business, and so we tender high so we don't get the work. We don't want to be somewhere where we are not the best in everything we do. Number 1 or 2 in service delivery, service quality. So if I look today, for example, our approach in fracking, we wanted to tell the customer we can replicate this efficiency that today you see in the Permian and the Middle East. And everyone failed in getting to that level of 10, 12 stages a day. Why everybody failed? So we put a formula that is very unique. We made a partnership with NextYear here in the US. We got a hybrid crew from the US and the local. And we looked at all the supply chain, every lesson learned that you do here in the Permian over the last 20 years, what works the best. In addition, you have your local knowledge where everybody fail. When they go there, they fail miserably because they don't understand the local environment, how to operate. in the desert in the Arabia. So we get the marriage of both. Today, our service delivery is the number one. So when the customer compared us to, you want to call it big three or four or whatever, we score the best in everything we do. And that's exactly what the same approach we do for coil tubing, for cementing, for drilling. And that's how we can justify why we can gain that market share, right? So usually the clients say, okay, local company, but I will have to sacrifice the quality. And it's the message we are passing actually is the opposite. It's we are local company and we're going to have a better quality than international. To do that, you have to make sure that you walk the talk. So don't take work that you cannot deliver as the number one. And that's why we don't sell technology that and obviously the technology we get it from the partners. So some of the stuff that we don't have, we do the partnership and making sure that so today we have a new partnership, for example, for water, and taking one company here and sending it to the Middle East, and we have again a partnership to deliver on it. Similarly, we're going to do something on direction drilling, and that's how you get the exposure on the technology we do not have. Because if I come today and tell you I claim that I have a better technology than the big three, it's not true. I don't. But it's a service delivery and a very focus on the customer. The other part that is very important is cost. You have to remember that today, as the cost per barrel increase for the national oil company, they look at, I want to save cost like everywhere else. So I can bid the same or a bit less than the big guys and still make money, better profitability, because I do not have the overhead. So we are very lean, and that's how we can. So you maintain the quality, you are a better service delivery, you are local, your cost is the same or maybe 5% less, but you make higher profitability. So the formula is very clear.
And you touched on M&A a little bit there as you look to expand further. I mean, what kind of opportunity set do you see for M&A in the Middle East and some of the jurisdictions that you're looking at? And is there any particular business lines that you'd be more interested in than others?
So it's a mix, I would say. So in some of the countries where the tendering process is very, very tough, and the contracts usually are 3, 4, 5 years, sometimes 7 years. So if I want to enter a certain segment of the market where I don't have, and it's very complementary to my portfolio, and the other local company has a very good position in those segments in this country, then that's the ultimate call for us. And that's what we are discussing. I will not do something that is basically a duplicate of what we have from a geography or a product line, because it adds no value, right? It's just going to be very similar to a consolidation, but I can do this organically without paying any premium. So that's the philosophy. So today, is there a lot of companies? Yes, there are a lot. The issue is we need to make sure as well the governance of the company is proper, because we are very, very high on our G for ESG. So we made sure that we are incredibly well governed, and that's how we show the whole market that we are US GAAP, complying with the New York Exchange or NASDAQ. It's all this parameter. The company has to fulfill that to be able to come to the group, basically. So I would say I am negotiating now 2-3 deals, but for the people that knows Middle East, it takes a time to negotiate a deal and come to some sort of a proper valuation and a proper DD. So I would say hopefully we learn something next year.
And would those be similar in size and nature to Sapesco? Is that sort of a fair representation of what you'd expect to be buying?
Yes, absolutely. Yeah.
Excellent.
Today we are one of the largest by far in the region after the big guys. So there is nothing really that big, but there is a couple of big guys, but you have to see as well value versus size. So I would say majority of the M&A that we're gonna close on will be similar to the Sapesco size.
Yeah, gotcha. And one of the things that really jumps out at me is how high margin you are as a business. And so if I think about past the growth phase of your business, Do you think about instituting a return of capital sort of model, whether that be through dividend or buyback? How do you think about returning shareholder value long term?
Look, I mean, honestly, today we are focusing on growth and getting the company to that size and maintaining that profitability at the right level. We definitely gonna make sure as well that we are always very low leverage. So we like the 1.5, 1.6. We like it even better if we are only one time leverage, right? So we paying down debt to make sure the strength of the company, keep investing. And then if once you reach that level of, I would say $2 billion revenue, 600 million EBITDA, significant cash flow of like 300 million or whatever. So then definitely we will start to look into dividend, buyback, etc. But I think until we are at that level, we are into the growth mood, which is today. I know for a fact that we are very unique because there is nothing in the energy sector that has that growth profile of 25-30% a year. So we maintain that. If I'm going to compete on dividend, you might as well go and buy Total and get 8% dividend, right? So I think for us, it's really the focus today is to grow. And once you reach that level, very good balance sheet, and a lot of free cash flow, then we look into what's next between buyback and dividend.
So maybe when you do attain that 10% market share, that's when we can start to think about that next phase of return opportunity.
Absolutely, yeah.
Excellent. And, maybe last question here, but what's the key risk to your business here? I mean, we've just come through COVID or going through COVID, depending on where you're at. How's that impacted your business? And do you see any other risks to your execution out there?
So I have to say that the COVID was a plus for us, right? So we maintained 100% capacity at all time, being local and being very diligent on our approach on the CMT, right, which is the crisis management team. We know how to do this very well, so we did it as I say, a la Navy, right? So we had it's a daily call, every spare parts. We knew that the logistic will shut down. We got 6 months ahead of time on all our spare parts and chemicals, put it in the location, made a lot of consignment deals, made sure as well our people are ready, that whoever wants to stay has to stay. Whoever cannot stay, we had to replace them ahead of time. So we maintained 100% capacity, which enabled us to actually gain market share because the other guys were not ready. So I would say the COVID was a plus to us and not a negative. The COVID situation, I mean. If I look at the preparedness of the region, can I grow when the region is shrinking? Yes, and I proved that this year. And if you look at our, since the company were together, even without us, with the two guys alone, the two companies that we bought, they kept growing in the 2016 downturn. And this year, the market shrank by 25-30%, and we are going to grow by 25-30%. So we are opposite to the whole. So I would say there is nothing without a risk. But today we prove the point that even with all these conditions, we maintain the growth profile and we even grow higher. And I would say this is something we can keep doing until you start to have a certain scale that it will, if the market shrink, you will shrink as well because you are a big part of the market, which is 10-15%. You start to see that. But until you are at that level, I think there is very limited risk. The only other risk is definitely gas price and oil price total collapse, where the client said, okay, guys, I don't need to do anything. I can produce, which today they can. They can shut down 80% of the rigs and produce the same. So if they do that, yeah, then there is a risk on our business. Today, do I see it? I see actually less and less of that because you saw in the macro, Africa is shutting down. Everybody else is not drilling. So actually the majority of the demand when it comes back, it has to come back from Middle East and Russia. So I would say there is less risk and more upside going forward.
That's fantastic. And I think we've summarized the opportunity very well there, Sherif. Thank you for joining us today. And just in conclusion, I want to reiterate, it is one of the more unique publicly listed opportunities that we have in our coverage space, if not listed in North America. Again, high growth in very high margin businesses that are structural within the economies that they exist in. So huge opportunity, and thank you for joining us today, Sherif.
Thank you very much. Appreciate the time. Thank you.